Hello, everyone. Good evening. Let me take a moment to introduce our guest for today. So, today we have with us Sahil Kapoor, Head Products and Market Strategist at DSP Asset Managers. So, he leads products vertical and helps strengthen macroeconomic tracking for the investment team. And previously, he has overall 17 years of market experience in different roles. So he started his career as a research analyst 17 years ago, and he has also worked as a discretionary trader at Edelweiss Markets desk. And after that, he had moved to wealth management business. He had been very instrumental in initiating and scaling research desk specializing in equities, derivatives, commodity, and currency markets. So his last role at Edelweiss Financial Services, he conceptualized macroeconomics and markets teams specializing in asset allocation, market analytics, and thematic trends. By education, he's a graduate in science from Punjab University. He did his master's degree in financial market from ITM IFM, and he's a voracious reader and a fitness freak and very punctual in his daily routines, be it like work or his reading habit or the fitness thing. So very warm welcome, Sahil. So just in case I missed anything or maybe you can add to that, very welcome. And I would request you to start with like how your entry to the market happened. How did your journey start? Yeah.
Thank you, Prince, and thanks for covering that. Entry was not very planned. I think when I meet youngsters today, I feel that they are much more mature and they understand what they want to do much better. I wasn't like that, so you could say that when I was doing my graduation, I did not understand S of stocks or S of shares or the stock market at all. Um, Unlike, let's say, in Mumbai or in Ahmedabad, Gujarat, and Maharashtra, where people have at least some basic understanding of what markets are, or they have seen their family members, trade, invest, etc. In Chandigarh, I think at that point in time, financial literacy was quite low, and I had no idea about what it is. And so the entry into the financial markets was primarily because I joined an MBA course. I hardly had any idea what I wanted to do, in finance. But my summer internship was with uh, angel broking. And that point, I did a project in gold, which sort of opened up, looking at markets for me. And then I think I got recruited in Kotak Securities as a research analyst. So that was a beginning. And so you could say it was a chance, no plan to join this industry as such. As I said, I wasn't so forward looking at that point in time. And then things built on from there, and I understood some nitty gritties of the market and mostly on job training. And fortunately, the beginning of the career was research and then as a discretionary trader, which I think is a blessing in disguise. You get to learn on somebody else's money, which is very rare, an opportunity that you don't get. And that was a good, strong footing to understand markets. And at that point, I was trading across the world, across the globe, even as a novice. And that really helped in, creating a very wide range of experiences and, of course, a lot of learnings. Yeah.
Great, Sahil. And serendipity has a very big role to play. But again, how had been your experience switching the roles in the sense like you had started with the research analyst and then you moved into trading and various other roles. So how had been this evolution and in your last 17 years, Sahil?
Sure. So, Prince, it wasn't really planned per se. The only simple principle that I followed since the beginning of career till today is I have never said no to good bosses. If I understood that, my boss was helping me grow and making me understand more things, I never said no to any new role. And I've been doing that forever, even till today. And that is how I tried and got too many or got to many different roles within the last organization and also now outside of it. So that's been the case. Not saying no to some of the good roles that came my way, and also not saying no to a lot of projects that keep on happening across organization that help me, cross pollinate and even go to sales team, go to technology teams, and do some projects and build that understanding. So that is the only way I understand that I got those opportunities, and the other, of course, could be luck.
Great, man. Sahil, these days, like we have been hearing about the GDP targets. So, what do you think? How fast can India grow the GDP targets like 5 trillion, 10 trillion, or for that matter, 30 trillion by 2047? So, how do we make sense on these numbers?
All of them sound very exciting and almost reachable, right? And the problem with these targets are that if you go back to, let's say, 1990, nobody was giving these targets for China, right? And maybe at that time, somebody would be writing about France or Russia or somebody else, right? It'll be very hard to find somebody talking about India reaching 30, 50 trillion in 2050 at that point in time. For example, today, nobody's writing about let's say Ethiopia reaching 50 trillion or 30 trillion, right? Nobody even cares about it, right? Who knows? So it's only about when things begin to happen and size begins to emerge that these thoughts come about and these targets come about. But having said that, I think it's if we continue to do what we are doing and not make any stupid mistakes, there is a good chance that we reach some of these numbers. Uh, but the question is when. And I think that question is very important to answer. And maybe people who are listening to me now, I'll be able to give you very simple past historical data, which will help you answer this question yourself, rather than relying on anybody on social media or any expert. You can do it yourself, right? It's not very hard. So currently, we are at about $3.5 trillion of GDP, and if you look at the last 40 years, or if you can go back even further, 50, 60 years. So let's stick to last 40 years. Our historical dollar GDP growth rate is 7.3%, 7.26% to be precise. Now, this is the last 40 years of India growth rate. And if you dissect it by eras, so there is the noughties, 2002 to 2011, where Indian GDP in dollar terms grew at 13.2% CAGR, which is the fastest growth rate that India has ever recorded in our own history. If you strip that period out, okay, that's those 9 years. And why will we strip that period out? I will explain that in the next comment. But if you strip that period out, our average GDP growth rate is 5.5% on average, which is equal to the world GDP growth rate. Okay, which means that we are different and faster only because of that period. Now, what is special about that period from 2000 to 2011, 2002 to 11? The world GDP was also growing at 7.5% at that point in time. So, A, we were outpacing the world growth. B, everybody was growing. So that sort of benefited India quite dramatically. Uh, if you look at statistics, I was in markets even at that point in time. And on each and every statistics, we were roughly 1.5 to 2 times of emerging market growth rate. For example, if EM exports were growing at 10%, we were growing at 20. If in most countries, if their, let's say, tax revenue growth was 8%, ours was 16. There was a period where direct taxes in India were growing at 25% CAGR over a 4-year period. Government had so much money that it did not know what to do with it. So enacted many programs like food security, etc. They were enacted in that era. So the idea is 7.26% over the 40-year period. That is our growth rate. Now, how do we know when will we reach 5 trillion, 10 trillion, 28 trillion, 30 trillion? So let's assume that we continue to do what we've done over the last 40 years and we continue to grow at 7.2, 7.3%. Let's stick to 7.2% and apply the rule of 72, which means that in 10 years, you double. Okay, it's very simple. If you grow at 7.2%, for example, if you put money in FD at 7.2, it doubles in 10 years. So similarly, your GDP, 3.5 today, in 10 years, it doubles to $7 trillion. So in 2023, if you close at 3.5 trillion, if you do what you've done for 40 years, by 2033 or 32 or 33, your GDP will be 7 trillion. Okay. Now the question is, can we do it faster? A lot of people believe that we can do this faster at a quicker pace. For to answer that question, we have to dissect. What are the engines of growth that we've seen? Are there any global examples who have done this in the past? But maybe we'll come to that as we discuss, more things going ahead. But one very, very important comment: this 7.2, 7.3% growth, let's stick to 7.2% growth over the last 40 years, also came at a much lower base. Okay. When you are at, let's say, $1 trillion of GDP, you grow at 10, 12, 13%, it's quite possible, right? As you gain size, it also becomes a lot more difficult to grow at a faster pace, right? Your denominator becomes much larger. So that is also a stumbling block for large countries, but not so much for India, because geographically we are widespread and we have still a lot of population which is aspirational in nature and needs to grow and get to the next bucket. But these targets of, let's say, 10 trillion, for 10 trillion you have to become, you have to double and then do another half of it, right? So you will require maybe 13, 14 years to go to that number of $10 trillion, given if you continue to do what you're doing. But if you look at our most recent data, last 10 years, 12 years, or post global financial crisis, our GDP growth rate has actually slowed. It has not quickened. It has actually slowed down than it used to be in the prior period, which means that we need to grow faster than what we've done in the last 10 to 15 years, and also at a bigger base. So it is going to be a challenge. It's not going to be easy, but we have done in the past, and this is what the numbers show, that you get to 7 trillion in 10 years if you continue to do what you're doing. But can you quicken? And maybe I think we can talk about that also. What are the various levers? Yeah.
So, Sahil, you talked about those 9 years. So any semblance on the ongoing period? Like, do you see like we can still outpace in comparison to the global markets at this point in time?
Um, I think it's quite possible, right, that we could outpace, but we still need to understand, uh, what are the key ingredients which went into that period, right? One of the most important ingredient for 2002 to 2011 was everybody was growing. So let me tell you what was special about that period. So if you look at the last 100 years of commodity price data, okay, strip out base metals and probably the oil shock of 1970s and 80s, and look at all commodities put together. Most commodities performed only in that decade. Okay, they went up and then crashed, which contributed significantly to a global inflation and also to top line growth. Okay, so when commodity prices go up, what they do is they create inflation. They also create a very large top line. Okay, what is top line? Sales revenue growth. The revenues of the companies go up significantly, and emerging markets benefit a lot from very high revenues. Okay, because in emerging market, consumer behavior is driven more by nominal growth than by real growth. But let's not go in that deep direction. But one simple idea was, into 2002 to 11, two very special things happened. First, every single country was in a synchronous growth path. That means all countries were growing together. If there were period of lull in between, they slowed down together. So it was like a lockstep. Second, the world was becoming a lot more globalized, with China getting into the global picture, and with very, very strong credit generation happening in China domestically. Third special thing which happened was that United States started to import a lot more from emerging markets in hefty quantities outside of oil and gas. Until before that point, it was importing a lot more from Japan. And then with China's entry into WTO, US shifted its strategy and allied economically a lot more with China and other peripheral ecosystem. And that created a very strong driver for growth. And third, and very special backdrop was ultra loose monetary policy in running up to that period, right? And then, of course, Ben Bernanke came in and then raised rates, etc. later on from 2004 onwards. But until then, the globe enjoyed extra loose monetary policy. Uh, if you look at all those ingredients, are they present today? The biggest ingredient, which is growth in lockstep across countries, is absent, right? Most countries in the world, for example, there are three large blocks of global growth. So if you just to put the numbers in perspective and how to think about them, so just think about this. The global GDP is about $100 trillion roughly. Um, Out of that, US is $27 trillion, and Eurozone will be around $24 trillion. So both of them put together are about 50 trillion, and you add another 18 trillion of China. Okay, so $68 trillion between these three blocks. So roughly two-thirds of the global economy is just these three countries. Okay, these three blocks, Eurozone taking it together, right? Uh, Currently, US is sort of middling in growth. One sector doing well, services doing great, and manufacturing in recession. Eurozone is completely in recession. Most other countries, and China is also slowing down. Right. So the global growth is not so synchronous right now. Some parts of the world are doing well. Most parts of the world are not doing well. So the base key ingredient is absent. Second, do we have ultra loose monetary policy right now? I think it is debatable. Interest rates are high at multi-decadal highs, but maybe the monetary conditions, that means the monetary base is still available. It's still very loose, not very tight from global standpoint. But if you keep on ticking boxes, I would say 7 out of 10 boxes, if you want to tick between these two eras in comparison, they would be amiss. They would not take, and it will be very hard to say that we are back to those periods. This is a very different period, unlike the period in 2002 2011. So the short answer is no.
Right, great, sir. So, Sahil, like before coming to discussing the key drivers of India's economic growth, a quick question on China. So, do you think, as you were pointing out, that US had started importing big time from China? So, does that shift is happening towards India, or it will take its own time? What's your take on that?
I think it will take a lot of time. There is some very small baby steps, you could say, that we are seeing in some sectors, but I think we are still far away from replacing China meaningfully. Um I don't know where the numbers lie today, where we can comfortably say in which sector that we have started to make inroads, right? The scale and size is very, very different. Uh, and this answer pertains to when we talk about India. Okay, when we talk about sectors. So, for example, if you talk about, let's say, a chemical sector or toy manufacturing in India, or some inroads in mobile phone manufacturing in India or assembly in India, we have made some inroads. There is no doubt about it. But when you talk about from India's perspective, the numbers are very small. I don't think that we have made any significant inroad in changing that. Our numbers are very small right now. They can become big over time, but as standing today, I don't think we produce anything significant to derail China. So just to case in point, uh, there are so many people on the call today, 104 people right now. Think about what is the biggest produce that India does. What is our largest production item in India? What do we produce the most? It's coal. Okay, we our number one item that we produce is coal. What is the number two item? It is natural gas. You will not even imagine that we could be producing natural gas at number two. And the reason for that is not that we are great at producing natural gas, that we are pathetic in producing all other natural resources. And I'm not talking about agricultural commodities. In most agricultural commodities, we are at number one or number two. But we don't do any. value addition to agricultural commodities. We export them as they are. There is very little that we do in terms of value addition. So apart from that, if you don't produce a lot of natural resources, your ability to export stuff is dependent on what you import, right? So you become a converter. For example, importing a lot of gold and exporting a lot of gems and jewelry. We are great at it. We do $40 billion, the highest in the world, right? No doubt about it. Last year, India exported $100 billion of oil products. Nobody could have imagined it because of whatever happened in Russia and Ukraine, right? We are great at refining and sending products, but we don't have our own oil. So if you take commodity by commodity, and if you take export code by export code, you will find that there are very few items where we are competitive at scale. Uh, Maybe there are some inroads that we are making in some defense manufacturing where things are looking up. But apart from that, there are only two areas where we have made solid inroads over the last 20, 30 years. One is auto ancillary, where I think we are one of the undisputed kings globally in terms of quality, and the other is pharmaceuticals. I think these two things are something which India truly is, has made inroads, and probably they both are significant for adding to India's kitty. But apart from that, from manufacturing, I don't think we have any significant inroads anywhere else. Services, yes, but I don't think we have a competition with China there, so the question will not arise. So the answer to your question is maybe in the future, but not right now.
Great. That brought great clarity on this aspect, Sahil. Thank you. So, coming to the key drivers of India's growth, what do you think are the key drivers, and with which we can try to outpace other economies in the world in the days to come?
So I think one of the best things that India has done over time is to create a few sectors where we excel. Okay, one of the most important one, of course, is the services sector. We have displayed tremendous growth there, and not just once, in multiple time frames and multiple sectors. So IT services, exports being one, and now over the last 5 to 6 years, we have also started to show capability in global capability centers, GCCs, where professional services like law and finance and consulting are being done in India. The numbers have moved from roughly nil to 40 billion over a 5 year period in that export segment. So that is something which is a very large driver. When I look at the overall numbers, the total exports of services and professional services that we do is now getting closer to 300 billion annually. So we are getting close to 8.5 to 9% of our GDP in terms of that number. The services gross export number. This is not the net number, but the gross number. This is a very, very large number. And when you look at the global comparison, uh, I think we are at number one roughly. If you add China, you will have to add its legal services, and it will surpass India in this number. But if you just stick to IT and IT allied services, India is way ahead. I think we are thrice of their number in only that segment. But and the next country, if you exclude United States because of the licensing that it has, the next country will maybe Philippines or other smaller countries will be not more than 20-30% of our overall numbers. So we that is one single driver that we have excelled in. Second major driver from an international arena for India's growth has been a very large contribution of NRI money flowing in, and this is one of my favorite questions, or sort of a trick questions, when I ask people, what do we export the most? And a lot of people think it is software services, which is the right answer, but it is actually people, right? Because NRI send about $125 billion inwards, which is a very large number. The number two country, which is Mexico, is at 60 billion. So you can imagine the size and scale of the remittances and transfers that Indians do from abroad to India, which is a very large number. Uh, So these two on an external front are large driver for domestic growth. They create a good, strong footing for the overall economy. Domestically, I think our complete economy resides on domestic consumption. And domestic consumption is the single most important driver of India's growth. Uh, and over the last 20, 30, 40 years, each and every cycle that India has seen, where the growth has accelerated, whether 2002 or onwards, and one period in 1980s, and then another period post-COVID, in each and every cycle, one favorable factor that has played positively for India is a loose monetary policy. Okay, monetary policy which is not very tight, where the central bank has kept interbank liquidity in surplus, and it has happened only twice. One when Mr. Y.V. Reddy was governor in the 2002 to 5 era, and now when Mr. Shaktikanta Das has become governor. Otherwise, India has always run a liquidity deficit or close to neutrality. There are certain artificial periods in between where we constructed some surpluses, like post the global financial crisis and during demonetization. But those periods were artificial construct. They did nothing to help the economy. So the drivers, if you look at it from a domestic standpoint, is of course consumption. And how is consumption aided? It is aided by availability of credit. Second, availability of cheap credit, okay, which is one of the most important contingent conditions in India. Sounds counterintuitive because a lot of people believe that India runs on unorganized market quite a lot, but the second round effects of cheap monetary policy or loose monetary policy or lower interest rates is very, very important. And the third lever, of course, is jobs, where in phases where we've been able to create high quality jobs, we've been able to grow at a faster pace. These three, I think, are the most important drivers. Uh, but what is the overarching reason which drives these three ingredient over a period of time? That I think is the way that we have created fixed assets, right? Or fixed assets creation. That I think is one of the most important lever. So let me, touch that point and try to link what I've said until now in terms of what drives growth. So if you look at our own history and calculate back 75 years of independence till now, we have spent about 14 trillion dollars on infrastructure creation, what is called gross fixed capital formation, GFCF, right? Which is, what is this GFCF number? It is you and I building our homes, or a factory putting in plant and machinery, or some airport getting built, or road getting constructed. Any sort of fixed asset which is getting created will get counted in this number. So we have spent about $14 trillion, doing this number. So in if you look at $14 trillion, so roughly it will be around 1400 lakh crores, right? Uh, I'm just taking 100 multiple, you could say 12, 12 and a half. So that big that number will be, right? And surprisingly, out of this 14 trillion, half of it, 7 trillion, we spent in the last 9 years, okay? Because our base has become larger. Uh, and in the next 6 years, we are again going to spend $7 trillion in terms of infrastructure spend. And this is not that we are doing something extraordinary now. This is our natural growth rate. And this number has become larger because our size has also become much larger. Now, if you dissect this number, the pace of growth of infrastructure creation between, let's say, 1995 to 2011, this specific period, on a year-on-year basis, the growth rate was between 13 to 14%, a very strong number on an average. From 2011 onwards, up until about 2020 lows, which is the COVID lows, this number fell to a measly 7-8%. Okay, the overall spend on infrastructure, and that slowed down the economy considerably. Okay. Uh, this number has again picked up after 2021, and largely because of three, four reasons. One, government's commitment has come back. Second, availability of credit has made a comeback. We went through an 8-year pain of cleaning up our banking system, which was not so clean, and now it is capable to lend money. It was not for about 8 years. And of course, we've got demand which was subdued for a long period of time. We saw a revival post COVID of, you could say it is short term or long term. I don't know. I don't have an answer, but there is certainly a revival in demand. So these three ingredients put together has again caused our investments numbers to go up. And now the new lever which is coming up is that corporates are also doing investments. So why they are doing investments? So if you go back to December 2019, uh, if you take BSE 500 companies, their net debt number was about 12 lakh crores. If you go to March 23, that number became 8 lakh crores. So there was a large deleveraging cycle which played out. Profitability was very high. So if you look at a business which has become more profitable and is sitting on lesser debt, it is expecting demand. What will that business do? It will do more investments. So fixed asset creation has again gone back up. And as you build more fixed assets, there is a likelihood that you will create more levers for economic growth. Why is that? I will not go into let's say, a long chat on economics, but just to give you one simple, layman logic. If you build a road, for example, there is a highway being built from Delhi to Mumbai. Over the last 70 years in India, nobody would have thought of buying a car to drive between cities. Forget about driving between metros, right? People would use a railway or an airplane at best, but nobody would have thought about driving. Our truck speeds were measly 25 kilometers an hour, and freight rates were sky high for the time they took. These simple infrastructure changes will create a new class of consumers, both in businesses and people like us who would want to travel between cities by road, creating additional demand for multiple things, right? Not only vehicles and on-road services, but for multiple things. And infrastructure creation is a big enabler. And that I think goes and links directly back to your consumption patterns and therefore helps the growth overall. So, what drives India's growth? Uh, Fixed asset creation, I think, is one of the most important aspect. And second, because our economy is largely consumption oriented, strong, healthy consumer balance sheet helped by cheap credit is something which is very, very important for us. Yeah.
So Sahil, any bifurcation or maybe some understanding on the consumption in respect of urban and rural, so we can understand the with better view, if you have any data or maybe any pointers to make.
So yeah, Prince, it's very hard to divide economy in urban and rural brackets because not a lot of clean data is available. But RBI has in the past published some data saying that nearly two-thirds of Indian economy is still tier two, tier three rural oriented. And there are not many hard data points that CSO publishes to ascertain what's happening. So we end up using only what is available in terms of IIP numbers or GDP numbers when they are printed, or the listed universe FMCG companies or two-wheeler companies and tractor companies reporting their numbers and talking about them. Um, as things stand today, whatever we've been reading and understanding data, the rural economy, tier two, tier three, is still very slow. It has not recovered fully. The urban economy or super elite is rip roaring. It's going all guns blazing. There is no doubt about it. But a better large part in numbers of the economy is still recovering. It's still trying to recover, not fully there. The other part of the economy, as I said, super elite, is already sitting at the peak. It's doing very well and continues to do quite well. But if you want to split the numbers, roughly you could say that in value terms, if you are an investor and if you're looking at the listed universe, the rural economy does not matter to you. So it's mostly a question of economics versus investing. If you're an investor, you don't need to bother about the rural economy. Uh, we did a calculation which showed that more than three-fourths of all revenues of all listed companies come from urban center and tier two cities. So you really don't need to care about what's happening in the rest of the universe, in rest of the country, if you are just focused on your investing. But from the country standpoint, the division goes in favor of the rural economy and in the unorganized sector.
Great, thanks, Sahil. So, Sahil, manufacturing is one important area. So, what do you think? Why we have lagged in the manufacturing, and what we are doing about it now? Do you think this manufacturing is booming at this point in time?
I think it's a very sensitive question, Prince. A lot of people believe that India is doing very well in manufacturing, and it might be true for certain sectors, bottoms up. As I said earlier, two, three sectors where we've done very well. For example, auto anks. If Tesla decides to come to India, I'm very sure that India can supply everything that Tesla needs in-house. It doesn't need to import anything apart from batteries. And the other is, of course, pharmaceuticals and chemicals, where we excel. But apart from that, I don't think we have created any scale in any industry, right? You can pick up uh, things that we export, as I have already explained. Very few things that we export. The largest item that we export in India, apart from oil products, is engineering goods. Out of those engineering goods, 70% of everything is auto ancillary. 50% of all manufacturing in India, value wise, is contributed roughly 46% by auto ancillary and autos. So, this is the whole gamut of what we do. We have started to make certain inroads in uh, electronics manufacturing assembly, not particularly creating the electronics. Right, we are still assembling them because most of the things are imported from outside. So it is still early days. And apart from these industries, we manufacture very, very little, right? For example, if you go to a restaurant and look around and see the number of people sitting there and think about what all is made in India in that room, you will find very few things, right? Even the shirts that people are wearing are hardly made in India, right? So we are trying to change these things. In certain pockets, we've been seeing some green shoots. Toy manufacturing is one where things have changed. But these are very bottoms up sector, sub industry oriented ideas. They don't make a difference at the country level because the numbers need to be very large. You need to be, if you want to contribute to a $3.5 trillion economy as a sector, you need to be very, very large. So if you look at the pecking order in terms of manufacturing, um, two sectors I already spoke about. The third, where we have excelled domestically, is cement manufacturing. Okay, where we can do everything from scratch on our own, and we become sizable. And cement is a localized commodity. You can't export it, right? So that is also where we have excelled quite a lot. Apart from that, we are mostly converters of all the things that we do. And where do we see green shoots? One certain area where we are definitely seeing green shoots is defense manufacturing. Our missile systems and uh, all the defense equipment that we are creating. There is demand globally for importing Indian missile systems, which can happen over the next 4 to 5 years. But apart from that, these few sectors, I don't think we are making any inroads specifically in any particular sector which is large. I see these numbers, for example, $50 billion in terms of mobile phone exports and manufacturing. But we should remember that all of this is still assembly. If you pick a mobile phone, we are talking on a mobile phone right now. And if you just see what are the components that goes inside making a mobile phone, the chipset will be one of the most expensive one out of it, and that component we don't manufacture in India. So much so that forget about chips, we don't even have a plant to make a silicon wafer. We don't even have a plant or the land for a plant to make a make a plant, right? We still don't even have uh, fixed area to demarcate to produce these things. So I don't think we have made a progress. We have made any progress in that direction. Uh, Maybe it's a value chain that will get created over time. One large area where we used to excel in the past is textile and ready-made garments, but that number has also slowed down for some reason. In the last 10 years, our textile plus ready-made garments overall growth CAGR in terms of exports is a measly 2% or 1.5%. Nothing significant has changed there. So I don't see any major areas where manufacturing has become a very large strength for India, apart from the areas which I spoke about, which is auto ancillary, pharma, newly coming of age, defense systems, and certainly some other smaller sectors like chemical, which are more bottoms up oriented.
So one quick question on in like if we draw a parallel to China. So when China started and become a manufacturing hub, so
Yeah.
was it a gradual shift or they had infra in place prior to that? How had been their journey? I mean, if you have any sense around that.
See, largely as per my understanding, it was a long journey. It took, I think, almost 15 to 20 years to map it out and do it over time. And one of the most important ingredients which went into developing it over time was getting the underlying commodity infrastructure in place. So, for example, let's take the example of why we missed the uh, growth bus in terms of manufacturing. Okay, look at the last 20 years. What is the biggest miss that India had? It was availability of energy. Okay, we had no energy domestically. We imported everything in terms of oil, natural gas. We imported all of it. We produced all of our domestic electricity from coal, and even we had to import coal, okay, for a certain period of time. So energy needs were not met domestically. So we had to import it. And that created a big problem for creation of manufacturing, right? Most manufacturing processes are nothing but energy conversion cycles. If you think about it scientifically, right? You are converting using energy to convert one thing from the other. And if you don't have your own cheap source of energy, you will never be internationally competitive, or you will have to give outsized subsidies by the government utilizing a large amount of debt. So we took neither of them. Now, as things stand today, look at the next 20 years. In the next 20 years, we need to, for example, let's assume that we need to transition to green energy and to, let's say, electricity. Okay. Why electricity? Because electricity is the most flexible form of energy. Okay. So there is a maybe let me take a small detour and come back to the point. Why electricity? Because if you want to burn any fuel, you need an engine, right? If you want to burn oil, petrol, diesel, whatever, you need an internal combustion engine to burn the fuel or coal, etc. But once you convert energy to electricity, you just need a push of a button, right, to switch it on or switch it off. So electricity becomes the most flexible usage of energy. Now, if you can produce that electricity in any manner, utilizing any sort of source, it does not matter, right? Eventually, it will matter is what does it cost? Okay, so over time, once you take care of the cost, everything from a user's perspective, if I'm a user, I will always prefer a electricity-driven apparatus rather than it being driven by a combustion engine. So eventually, everything will get converted over time. This is my assumption. I may be wrong. It proved wrong 100 years ago. It could again prove wrong, right? In the next 100 years also. So if you go back to 1910, Thomas Edison said that this is the most efficient way of running a car, which is a electric vehicle. Ford used to work for Edison, but Ford thought the other way and created a new vehicle which dominated for 100 years. And now again, maybe a transition is happening. But to come back to this point, if you are transitioning to electricity, does India have the capability to take advantage of that, upcoming change? So what do you need to take advantage of that? You need to have a battery infrastructure in place. Okay, what do you need to create these EV batteries? You need to have the underlying ingredients, okay, which is lithium, copper, cobalt, etc., etc. If you look at who controls these materials, all of them, 90% of the value chain is controlled by China. Okay, we don't have any of them. Not even a single source of any of these commodities is produced in India. Neither do we have global tie-ups, or we have bought any mines globally to produce any of them, or any plant to service them or produce them locally. So last 20 years, we made the mistake of having no oil, our inability to create any cheap energy infrastructure. Next 20 years, this mistake can repeat, which again can cost us a lot in terms of manufacturing. Uh, the only good thing which is happening domestically right now is an effort to transition to solar energy. Okay, that transition is still very, very nascent. It will take a long time to happen at the pace that we are doing right now. A lot of people believe it is very fast. When you look at electricity production figures, the numbers appears that solar is reaching 15%, 20%, and will reach 50% by 2030. But in totality, India's solar energy by source is only 1% of our total energy consumed, which is very, very small. It is not even a drop in the ocean. So it will take a long time to get to a sizable number, which can impact the overall economy. So now, if you contrast this to China, I think the numbers are entirely different. The ability to get infrastructure was created from 1995 onwards. If you go back and read the literature and read the Chinese companies like CATL and others going to Africa, Congo, buying mines. They were buying mines in 2003 and 4 and 5 to create batteries, which they are creating today. So there is a long gestation period which takes place over time, and they have beaten every other country. It's not that only India has been left behind. Even European countries, Western countries, Latin American countries, nobody been able to compete with China, right? In doing that. So we are in the same bus as other countries, but can we make the progress now? Maybe yes. The answer is yes, by correcting these steps over time. Are we doing it right now? I don't think so. I don't read that any of this infrastructure is getting created. I do hear and read about a lot of announcements where companies are announcing these plants and saying that we are going to create some of them. But I'm yet to visit a plant where something concrete is happening. There are two plants where the work has started. One is in Kanyakumari, of course, from the Tatas. Others, I think, still work in progress. So, if you compare these two countries for manufacturing, uh, we are yet to make any start.
Great, Sahil. So, Vipinji, you had your hand raised. Any questions? So you can surely ask. Yeah.
Yeah. Good evening, Sahil. Actually, I have a different perspective when you talking about the manufacturing, why it is not picking up in India. It is, I think, more of willingness of government as well as the private sector. When private sector is willing to put up a plant, so government or the forces behind the government don't want it to be developed in India. So if you see in today's context, what will happen in last 5, 6, 8 years, that they are pushing up for made in India perspective, and now when we are almost 100% import dependent on this defense equipment, we are now exporting it rather. So gradually it will grow, and I think it is a willingness more than the ability which is force behind not happening in last 70 years in India. So I think we should look with a different perspective, that sometimes government don't want you to put up a plant to please some of its some of its backers. So I think now this dilemma has removed, and we are progressing very high, and in defense, in manufacturing. So if you take the example of this laptop or mobile phone manufacturers, I remember when our minister Chandrasekhar told that we have called a meeting to initiate a push for Made in India. And they attended the first meeting, the Dell, the HP, Samsung, everybody, every biggies name. And after that, they called 5 meetings and nobody turned up. So when one fine morning, they issue a notification that nothing more will be imported as far as this laptop or mobile is concerned, or telecom equipment is concerned. So come what may, you cannot import it. You have to take the special license for it. So then next morning he told that there is a huge line before his office to take some time, that we will put up a plant here, or we'll start manufacturing. You just give us some time, otherwise what will happen to India need of laptop and mobiles. So the government told them, nothing doing. We will only allow that much time. If you can do it, okay, otherwise we don't require your equipment. So there is a willingness of the government which is more required at this point of time.
Sahil has explicitly made a point about the intent of the government, so that is well taken. But again, he was talking about the ground situation. But again, all perspectives are valid, and you are right on your front. Any remarks to make, Sahil?
Yeah, just 2, 3 points. One is that I think all governments are a reflection of the people only, and we only elect governments over time. And so one very important difference that I have seen over time. I was watching a stand-up comedy act, and the stand-up comedian spoke about the job that he was doing earlier, and he showed and picked up a dress of a chemical engineer working in a factory, and everybody, the audience laughed, saying that this guy used to work in a factory, and he said that I wanted to work on a laptop in an AC environment and doing something and having coffee. Okay, this is what we want to do. This is what I also do. Ask anybody in India's youth what would they prefer? What type of job would they prefer? Currently, we don't have the mindset of creating very large scale infrastructure manufacturing outfits in India. That needs to change, and it can change over time. We can create specialized sectors where we excel. We have done that in the past in a few sectors. Are we doing that enough? Currently, the answer is no. Can we do that in the future? I think all the levers are present. Credit access is available. Laws have been amended. Availability of demand is present. But I don't think that we have made that inroad right now. And if governments could solve all business problems, then I think you would have only required the government to run all businesses. But unfortunately, that is not true. There are 3 entities in any economy, and government is only one of them. The other two are households and private businesses. And in every economy, households and private businesses run 90% of the economy. The government's contribution is only for regulations, implementation, and law and order, and nothing more than that. So I think that role has to be understood, that government can only be an enabler. Eventually, it will be up to the households and the businesses to, do the heavy lifting.
That was my point, that government is an enabler, but in the past they are not willing. So now the willingness is there, so things will move gradually.
Yeah, I hope so. Yeah.
Yeah, right. And like, Sahil, see, India's grow as a certain pace, that is all fine. But how do we link these numbers to stock market?
Sure, I think it's a very important question, and a lot of people think about economy and these subjects are esoteric and they have got no relation. But if you just extrapolate a few numbers and look at the history, so let's look at some mathematics. As I said, the Indian economy roughly grows at about 7.2% dollar GDP growth. Okay, let's assume that this growth continues. Okay, from where we stand today. So next 10 years we double our GDP, and let's assume that in the next 10 years, corporate profits also double. Okay. This maths is very simple. It is also, let me also equate it to history. So if you go from 1990 to today, Indian GDP has grown at about 12.5% nominal growth. Okay. I will resolve this 7.2 and 12.5 right now in just 2 minutes, but stay with me. So from 1990 to today, 12.5% nominal GDP growth rate. This is also the about 11.5% is also the growth rate in corporate profits. You could say Nifty EPS. Okay, that is a simpler term to imagine. So Nifty EPS has grown at 1% lower, 11.5%. Okay, so which means that corporate profits and GDP growth rate in India has grown at a similar pace. Okay. It is not true for many countries. So I will not go in that direction. Maybe if there is time, we'll talk about that. But in India, it is true for the last 30, 40 years. Assume that it is true for the next 10 years also. So India grows at 7.2, doubles in next 10 years. Nifty EPS is going to touch about 1,000 rupees sometime in 24. I don't know which month or which quarter. Whichever month or quarter it happens, it will touch 1,000 rupees EPS. So in the next 10 years, by 33 or 34, it will also double. If GDP is doubling, corporate profits will also double. This is an assumption. So 1,000 rupee will become 2,000 rupees. Now, this is only the real growth rate. You have to add back inflation. Okay, so inflation drives corporate profits also. So let's assume that we do the RBS target of 4% inflation. So 7.2 plus 4, 11.2% growth. So what was doubling? So 1,000 rupees instead of becoming 2,000 will become 2,500. So Nifty EPS will become 2,500 rupees. Today at 1,000 rupee EPS, Nifty trades at 22,000, right? So 22 times. Historically, our last 25-year average price to earnings multiple is 20 times. Okay, so for 2,500 rupees of earning per share at 20 time price to earnings, Nifty will become 50,000. Simple mathematics, which means that in 10 years, if economy doubles, corporate profit doubles, Nifty profits will also more than double to 2,500. And the Nifty level, if we trade at our long-term average, it will become 2,500. It will become 50,000. So from 22,000 to 50,000, the returns come to about 9% or so. Okay, that is the return which, if we follow our own historical trend, is what it will happen. Okay, and this is just an extrapolation. Stock markets can go up or down much more than anybody can imagine, and I don't have any clue on how they will move. But this is the extrapolation of the past history, and if you just extrapolate that into the future. Now the question is, how do you improve this 9% return? What are the way and hacks to think about that? A lot of people say that we want to make 15-20% in India, small caps are giving 40%, etc. But the long-term picture is very, very different. If you look at 20, 30, 40-year history, you will have to think about in those terms. So if you want to improve this 9.5% return, which is becoming apparent from our own history, the only way to do it is to buy when stocks are cheap, not when they are expensive. That means if you buy when markets are down, when they are cheap, the ability of your portfolio to deliver higher returns above the nominal GDP, above the nominal earnings growth, rises manifold. Versus when you buy when the stocks are expensive, which is, for example, right now, when you are trading at 23 times price to earnings multiple, the ability of the portfolio to deliver 9% plus returns falls dramatically. I know it sounds very bad when you have very strong trailing returns and it becomes almost unimaginable to think about this, but this is how history has functioned. And this is, I think, how you extrapolate these numbers and think about markets.
Great, Sahil. So Hello. Sorry.
Yeah,
Yeah.
go ahead.
So Sahil, like broadly, we had a holistic discussion around the topic, but again, sectors to look for is always an interesting question in all the sessions. So, I mean, if you like to talk about that, which sectors from here, with a view of 3 to 5 years, you can, I mean, suggest to our audience, they can surely have a look at.
Prince, I would always prefer sectors which are trading at better valuations, and I think they offer a lot of margin of safety. And there are two, three sectors which are, which appear in that bucket. Number one, of course, is healthcare. I think a mix of pharma, path labs, hospitals, possibly is one of the best bets that India has to offer. Not only this sector is trading below its long-term valuation, but it is also trading below pre-COVID valuations. One of the rare ones, and earnings growth has just started to turn, from low single digits to about getting into the double digit category. In some segments, it's getting into high double digit category. And stocks have not performed for a very long period of time. It is under-owned. The overall weight of healthcare as a sector in India's market cap is just 3.5%. For any other mature economy, that weight is more than 10%. So overall, we are under-owned, underweighted, profitably better, valuation-wise also better. So I won't be surprised over the next 5, 7 years. This sector outperforms most other sectors. If you take the last 700 listed stocks, take their market cap, compare it to, let's say, only the healthcare sector, we are at 9-year lows today in terms of the overall opportunity. So I think this is one sector which could do very well. Second is, of course, BFSI lenders particularly. And as go up in the curve, for example, from banks to NBFCs to insurance companies to life, non-life to capital market companies, and I think the profitability profile improves. Of course, many of these businesses are more cyclical in nature. For example, the capital market businesses are linked directly to the market, but other businesses are more stable. Our credit quality is one of the best. According to our numbers, I think it is the best in last 20-25 year cycle. Credit growth is good mid double digits. I think it can continue at 12, 13, 14% easily. So again, BFSI is one of the most preferred sectors for the next 3 to 5 years. And third one is auto and auto ancillary. I think the whole sector is going to go through a shift. Many businesses will die. Old ones will probably also perform very well. So there is a lot of tussle which will happen in this sector. But I think from opportunity perspective, one of the better sectors. A lot of companies are cash rich, have no debt. Demand is coming back after 10 years. So I think this is another space. Maybe we can go granular in another session on some of these companies. But these three are the favorites right now.
Great, thanks, Sahil. And we are almost time. So thank you for taking out time today. It was really insightful, and especially understanding the space on the GDP thing and how we can, I mean, look at the growth drivers, and accordingly we can place ourselves in a sense of investing in the stock. And really look forward to many more sessions as and when time demands.
Thank you. Thanks, Prince, and thank you
So,
everyone
so, so
for
Sahil,
listening to me patiently.
before we close,
Yeah.
one quick question, like your reading habit and like taking care of your health. So, what's the motivation behind it, man?
Um, no particular motivation. I think it becomes a habit over time. It's largely, following the same thing. Um, I think it begins from, self-love sort of. That I think is the biggest driver, and nothing else. It's sort of a repetition, long, boring repetitions, and it builds on over time. That's about. There is no magic formula, so to speak. I mean, I can't give you a magic formula of doing this. It's just same old simple, doing it again and again.
That's cool. Great. Keep adding value in all the fronts. Really look forward to that. And thank you so much once again for taking out time. And thanks for doing this. And for our
Thank you very
audience,
much.
like we have recorded this session, and I'll be uploading this session over YouTube in some time. So definitely, you guys can listen to the conversation in case you missed. a look at Sahil's Twitter handle, where you'll get so many insightful and motivating tweets as well. So definitely you must have a look and follow if that matches your request. So thank you so much. Good night. Take care, everyone.
Thank you. Good night.